today we just want to go over kind of the information you can give to your clients, to your partners, people that you're working with, ultimately anyone in your sphere that is interested in understanding what you can do in real estate or in finance kind of post-corona, like what we expect or what we're seeing coming. So I've been I've been compiling this information for the past probably couple weeks, and adding to more of it as we kind of came up to this event. And so it should be very close to real time, even articles up to as early as this morning. But there's a lot of information in here because your clients are going to have questions. I'm assuming most of this audience is going to be real estate professionals, mortgage professionals. I know we're going to have some CPAs and financial planners on the call here as well. But ultimately, the premise of what we want to talk about is how can we be most additive to the people that we're serving on a continual basis. And for us, it's always been having information to share. So I'm going to go ahead and share my screen. If you guys have questions, you can go ahead and type it in the chat box here. But I want to make sure you guys have this, and then we're welcome. We can send this out to you all afterwards as well, so you can have the deck and you can have the recording also. All right. So again, title of today's topic is real estate and economic education for your clients post-corona. All right. So as I've said before, in times of uncertainty, the person who brings the most clarity adds the most value. And obviously, none of us have a crystal ball, right? But we can predict to with as much information as we have, we can help the clients make better decisions and more confident decisions with their real estate and with their finances. So some commonly asked questions that we get are, what's going to happen with the economy, right? Like, and probably more as mortgage lenders than real estate professionals. Obviously, financial professionals, CPAs are getting this question asked quite a bit. Another question we get asked a lot is there going to be a lot of foreclosures, right? With all the unemployment, with everybody that's unfortunately currently out of jobs, are a lot of these homes going to be coming back in the market, and what's that going to mean? Next is this going to be worse than 2008? We get that question asked all the time. Like, people remember how bad 2008 was, especially in the housing sector, and they want to be cautious of getting into something that may be challenging during that time. Next is going to be what's going to happen with home prices. This is probably applicable to everybody on the call here today. And that is, we have a lot of content around that, so we're excited to go through it. And then lastly is, what is the best thing for us to do right now? Right? And so we get that question a ton just because people aren't sure if they should buy, if they should sell, if they should go into forbearance, if they should refinance, if they should access equity. There's more questions right now that our clients have than probably any point in, at least in my career. So we want to arm you guys with information to help give more intelligent answers, more empirical data around those answers as well. Because quite frankly, unfortunately, our industries are seen as oftentimes salespeople, financial professionals, mortgage professionals, real estate professionals. They see us as selling something, we sell something, we earn an income. We want to really try and dispel that myth. The average consumer is sitting at home and they don't know where to go to get this information, right? They don't think that they can call a real estate professional and get unbiased information about buying or selling real estate. They don't even remotely think that they should call a mortgage professional to get unbiased, non-sales related information, because 99% of mortgage professionals do not do that. They just give people mortgages when they need them. So we really have to get clear on the information that we can provide, which will then spread. People will then start to realize, okay, we can change this industry for the better if we have information that we disseminate at a high level. So first thing I want to talk about here is really just, the timeline for this whole thing. I'm going to try and move this out of the way so I can see a little better, but it says, you don't make the timeline, the virus determines the timeline. This is Dr. Anthony Fauci who said that. And ultimately the same thing applies to the economic and housing market recovery, right? We can't really say what's going to happen until we start functioning in a more normal environment, right? Until that kind of virus is diminished. So this is a kind of amalgamation of a lot of different analysts in the medical professionals, kind of medical professionals and data scientists coming together to create this graph. So there's no one source for this chart, but ideally what they're thinking right now is that we've kind of reached that US new peak case in the early May timeframe. We start to get some of the testing capacity, and we'll start to see that new cases kind of move down here into June, with testing capacity to be about a million tests per day. And right now we're closer to 500,000 tests per day. Serology testing will be available. Hospitals are going to have extra capacity with ventilators. People start returning to work, which we're seeing in some states now earlier than others. But again, this is more nationally than regionally. We start to kind of see people wave 2 returning to work in July, August, schools reopening ideally in the fall, vaccine for healthcare workers. There is a pretty high level of expectation of a second wave of infections in the kind of early winter, that December, January timeframe. But assuming we all practice social distancing throughout that timeframe, we won't need to re-shut down the economy. We will be able to manage through that. And yes, there will be tragedies during that time, but it will be much more well prepared to take advantage of it from a hospital capacity and a healthcare perspective. And then ideally a broad vaccine available here in the first quarter or so of 2021. So again, this is the potential of what we can expect right now. Now, obviously, nobody can guarantee this. We could be off, but this is the expectation. So based on this is where we get a lot of the data around what's going to happen in different markets or different sectors of the economy. So some of you may have seen this, some of you may have not, but if we want to give people a good understanding of kind of what's happening with unemployment, unemployment here, you can see this is back in, I'm going to say 87. I'll play this here. Oh, sorry, 67. All right, so this is just weekly unemployment or weekly jobless claims. All right, so you can kind of, I'll stop it here at the Great Recession. So this is the Great Recession, right? This is 2008, 2009. We had another big one back in kind of 82. So there's some pretty big spikes here in weekly jobless claims. But to give you some idea of the scope of what we're dealing with now, this is what's happening today. All right, so it's going to go for a little while. And this is one of those charts that kind of hit you. Now, this was actually back in beginning of April, right? And so this is when we had about 6.7. This was the second unemployment. There were about 3 million at a time. And so now we're up over 30 million. Now it's not in 1 week, right? So the graph would step up from here. But ultimately, total 30 million people have filed for claims since March, totaling nearly 19% of the workforce. Now, some of those people are back to work. Some of the furloughs have been kind of taken off the table. And so we're kind of hovering around 15% unemployment right now. But it's a really telling graph when you start to think, how bad is this compared to previous recessions? We hope it's not definitely not going to be as prolonged, but it is substantially deeper from an unemployment perspective. So moving into the kind of economics, a lot of people are trying to time markets. They're trying to time the real estate market. They're trying to time the housing market or the financial markets. We've had a pretty substantial recovery from where we've come from, right? So this is kind of when it all started, late February. This was the height of the S&P 500. We were really 3,400-ish, give or take, kind of moved all the way down here, actually dipped into the low 2,100s, but we've kind of bounced back at a pretty good level, right? So we're not nearly as low as we were here. And what this means is a couple things. One is just in April, we saw the best month since 1987 in terms of economic recovery from a financial or stock perspective. Right, so slowdown in new cases. We've had just really good improvement since our March lows. Secondly, is that what this really means, in our opinion, is that a personally defined strategy is the best way to navigate volatility, because you can't give the same advice to two people. You just can't. Like, person A is going to have a very different financial makeup than person B. They're going to have different real estate goals or interests. They may own a home, they may not own a home. So personally defining the strategy for someone based upon what we're seeing is going to be really appropriate. And then as the economy starts to just recover over time, consistent guidance is really advised, right? And that's one of the things that we are proud of, and a lot of the partners that we work with, real estate partners, financial partners, estate planning attorneys, CPAs, we all work in a capacity where we don't just transact and then hope the client has the answers. We have consistent guidance, consistent follow-up, and our commitment to the consumers, we're going to help them now and for years into the future. So I would advise everybody on this call, if you don't have that same type of outlook, please implement it, because clients are going to need it now more than ever, especially with the continual volatility that we'll most likely see. This is a Morgan Stanley kind of forecast that they have here. So you can see, by the way, everything you're going to see is going to have a sharp decline in the second quarter of 2020, which we are, starting out right now. We're about a third of the way through. So, we're kind of in this area here. We'll kind of be coming out over the next couple months. But you can see in terms of real GDP, their expectation is Q3 and Q4. We're going to see a pretty big jump compared to even where we were in the first quarter or last quarter of 2019 and first quarter of this year. And these are all the different asset classes that they're kind of looking at here. So, the challenge with saying that we're in a recession is you have to have 2 consecutive quarters of GDP decline. And by the time you do that, in this case, we could potentially already be out of it, right? And so by the time it's announced, we could be on the other side. And again, this is Morgan Stanley kind of giving their insight there. So as you're talking to your clients, you always want to you always want to cite the source. So here's, 4 different of the largest, banks and economic institutions that are kind of giving their calling for the recovery in the second half of the year. And what you see here is, between Goldman, JP, Morgan Stanley, and Wells Fargo, everybody, again, Q2, pretty substantial declines in GDP, and you see, uplifting in third and fourth quarters. They're projecting businesses are going to rebound, just a recovery to start kind of the second half of the year. So you have to realize that, a lot of people think, well, they're putting this out because they want to create their own reality. That's not the case. If they're wrong and this is their strategy, they lose their clients a substantial amount of money. Right? If they're long on stocks, if they're long on equities, meaning that they're betting that they're going to move up and they don't, then their clients are going to take a real bath, right? So their projections need to be accurate. They can't be pie in the sky or hopeful in order to create their own reality. They really need to be that. If they really thought there was going to be a decline, they would plan appropriately for it, right? They may put shorts in place and they would have the opportunity to help people diversify out of certain things. So understanding that some of the largest financing companies in the country are calling for this really states that there's something to that, not saying they're all going to be right, because we all know that was not the case back in 2007. But they would really be missing out on opportunity, and then their clients would be fairly upset if they all missed it to that capacity. Have you ever heard the saying, "Don't fight the Fed"? It's really, it's one of the things that I've always found solace in, is that, or don't bet against the Fed. There's a lot of different kind of sayings around it. But ultimately, if the Federal Reserve wants something to happen, they can find a way to make it happen. So some of the things we've highlighted here is that the Fed does plan on keeping short-term interest rates near zero, continuing to expand its balance sheet with purchases of Treasury debt and mortgage-backed securities. So there's a really important component to this, which is, if they keep rates low, it keeps the cost of funds low. It allows the economy to recover at its own pace, and it allows mortgage interest rates to stay low as well, which we'll talk about a little bit later here. And then, Chairman Powell has just said, they're going to fight this thing forcefully, proactively, aggressively, and they want to see an economic recovery that is robust as possible. This is kind of a Fed's target rate that you'll see here. This is the entire recovery of the Great Recession. I mean, it started in 2008. So for 7 years, or almost 7.5 years, they left it untouched at zero. Right? And so they have the capability of doing that. You can see it started to move up here as the economy started to recover. This is when we started to see mortgage rates climb for the first time in quite some time. This was kind of the beginning of some maybe cracks in the foundation. This was just recently, obviously. And the expectation is that they will keep this Fed funds rate this way through 2023 or 2024, meaning that we'll have good access to credit. They'll keep the credit markets open. They'll keep credit flowing and liquidity as high as they can. So it's really important to understand that there's even talk of the Fed potentially stepping in and buying equities if there's any sort of break in the equity markets to where they can prop that up. Now, I'm not going to speak to the long-term ramification of this because it's unknown. A lot of these have ways of trying to inject capital back into the Federal Reserve through purchasing of different debt, but it's likely that we'll see higher tax rates moving forward. So that'll be something we'll all want to be cognizant of as we're planning through our timeline of our investments, right? So if for our real estate, our finances, We want to work closely with our CPAs in figuring out how to maximize our tax benefits and really look forward at what to expect because of the occurrence that we just had here. But good news is, the Fed will really keep us in the game. Next is going to be, will there be a lot of foreclosures? Very commonly asked question, and one that you would think, yeah, there's kind of has to be, right? I mean, with 30 million people having no income, I can't imagine that these people are going to be able to pay their mortgage payments. So, the same reason there was a lot of foreclosures back in 2008 with way less people being unemployed, there should be way more foreclosures now that, we have an astronomically higher unemployment rate. And that's just not true. So there's a lot of reasons behind that. One is that Americans are sitting on a tremendous amount of home equity, right? So 58.7% of all the homes in America have at least 60% equity. So if your home is worth, $500,000, that means if all the homes are worth $500,000, that means 58.7 of them have a $200,000 mortgage on it or lower. That number was way, way, way higher in 2008. Everything, people were putting zero down. People were stripping equity by doing cash outs, which has not been the case because everyone was kind of taught a lesson back in the Great Recession. 42% of all homes owned are free and clear, right? So there's no mortgage at all. So obviously they wouldn't go into foreclosure. And then the $177,000 is the average equity of mortgage homes across the country. So when you think about foreclosure, you really only need to go into foreclosure if you can't make the payment and if you can't do a standard sale, which is all the reasons why that was happening back in 2008, because standard sales require equity, right? They were short sales were not approved, so they went into foreclosure. Again, that's not going to happen for a huge population of the world or of our country. Next is going to be percentage of homeowner equity in 2020. So it's astonishing. Again, 42% have 100% equity, right? Free and clear. You look at, 16% of the population has between 60 and 99% equity. You get down into these numbers here, only less than 10% of America has at least 7.3% of home equity. Now, this could, like these two markets, right, where, you have 7 or 6% equity, they could have some concern there, and it depends upon where they stand in being able to pay their mortgage, in their forbearances, in their their stimulus checks. So there could be a population of this, but another reason why is forbearance. So I want to be careful on forbearance because there's a lot of people that are going into forbearance unnecessarily. Forbearance is really phenomenal for people who just cannot make their mortgage payment, and they will go into a further hardship if they do, right? They have to put everything on a credit card to be able to make their mortgage payment. They have to, take high interest debt to be able to make their mortgage payment, or they just simply don't have the money to make the mortgage payment, right? A lot of, I think something along the lines of 50% of America couldn't even handle a $400, monthly unintended expense, which is really challenging. So when you're thinking about forbearance, there's a lot of people that can take advantage of it and that it will make sense for. For everybody else, I would just urge you to be very careful about it. And I probably even go so far as to say, don't do it if you can at all avoid it. Simply because getting out of it is not going to be as easy as you think. There's going to be, it's not going to be deferred to the end of your mortgage. It's not just going to be, you're going to get a free ride. It will have to be repaid. And oftentimes it's either paid in a lump sum right at the point where your forbearance ends. It's added as a repayment plan to your mortgage for up to 12 months, which is already going to be a challenge to pay your normal mortgage. So then paying 50% more on top of that would be an even greater challenge. So the best thing I could do there is reach out to your real estate professional, reach out to your mortgage professional, reach out to the person that you have the relationship with that you trust the most. And they can really give you good guidance around if you should be doing this or if you shouldn't, and then the consequences around it. Because as you'll see as we get later into the presentation here, we're going to talk about interest rates and where we believe they're headed. And people going into forbearance at the moment will not be able to take advantage of those. Now that may change. The Fannie and Freddie and Ginnie, they may change their policies on, if you go into forbearance, can you get a refinance or can you buy a new home? As of right now, they need a 12-month clear payment history of making your payment on time. So that's really going to put you in a bind when amazingly low interest rates show up, or when there's an opportunity to take advantage of the real estate market. And there's some people that have called me that are just like, hey, my buddy got a forbearance, I'm thinking about doing it too. And it's just like, you don't have any negative impact. Now you could, because there's no barrier of entry in terms of hardship. Anybody can get it as long as they have a Fannie or Freddie owned mortgage. But only very few people that absolutely need it should take advantage of it. So again, reach out. If you're a consumer listening to this or watching this, reach out, talk to the trusted person that you have the best relationship with, get really good advice and guidance, and then they can help you not only plan on going into it, but plan on helping you come out of it, because the servicers are overwhelmed. There is way too much activity coming into these servicers, and they're just not staffed appropriately to handle this. So you're going to get a really brief phone call. If you even mention forbearance, a lot of times they just put you right into it. Right? They don't even ask questions, and all of a sudden you didn't sign anything, you didn't say you wanted it, you just find out that you're in it later, and it's a real challenge. So be careful about who you're talking to on it from a servicing perspective. Make sure you're very clear on it. But I would say talk to your mortgage professional or real estate professional first before you take that step. Another question is this going to be like 2008, right? So again, along with the foreclosure question, is that annual home price appreciation, right? So, we have 6 years leading up to the crash, then we have the last 6 years. So a lot of people think we're in this bubble and it's about time and it's going to pop because we've had so much appreciation. It's not even remotely close to what it was back leading up to the financial crisis, right? So 2001, 8.6%. 6.5%, 8.5%, 8.7, 12.5, and 11.5, all the leading up to that 2006, 2007 number. Now, there's a reason, and keep in mind, none of this was founded, right? This was an artificially inflated home price because you didn't need to qualify. You didn't need to show income. You just had to have a heartbeat and be able to fog a mirror. And if you could do that, you could get a mortgage, right? Which is why home prices went up so drastically. Now, fast forward to after the crash, right? You're seeing very normalized appreciation rates, right? And this is what an average appreciation for real estate historically will look like over the last 60 to 80 years. You're going to get 4 to 5% appreciation in real estate over that time frame. So the secondary part of this is that every single person you absolutely have to qualify for a mortgage. I mean, if you've gotten a mortgage in the last 6-7 years, you know that we are asking for pay stubs, bank statements, W-2s, tax returns, your grandparents' fourth grade report card, blood tests, right? Obviously, I'm being facetious there, but this is a very secure position from a real estate perspective. And people think, well, we went up and then we're due for a drop. We should have never went up here, right? There was no foundation for us to actually move up the way we did. So we can't even tell where we are in a normal real estate cycle. I think the idea of a normal real estate cycle was broken back in 2006 because we should have never had the run up to begin with, right? So we can't really put normal real estate cycles into the equation. We just have to look at something that's very clear. How much inventory do we have? How much supply of homes is there on the market? And how much demand is there for those homes? So we'll talk about that in a little bit. This is another thing, is the mortgage credit availability index. So as I was saying, it was incredibly high, basically meaning that any human being could get a mortgage back here. And you can see all the way through the recovery, and it's very slow here. We've only recently started introducing even remotely risky loan products, but they're still underwritten to a very conservative standard, right? So it's much harder to get a loan today, and even more so today, because since the pandemic started, lenders have really tightened up their guidelines. So this should help give people a sense of, okay, that's not going to happen again, mainly because we're not seeing this run up, and we're also not seeing anybody be able to qualify for mortgage. And then the secondary thing is, everyone thinks, okay, we're going to have some home price change because it's a recession, home price is going to come down. Really, there's only been one recession in the last, 20 years, 40 years at this point, that has had a home price reduction equate at the same time as a recession. 1.9% is almost a variable that would be considered even in most markets, kind of similar to the 3.5. But the 1980 recession, home prices actually went up. The 2001 recession, home prices, this is the dot-com crash, home prices actually went up. This is the only one that went down is because housing caused it to begin with, right? So, we'll see a small dip in housing prices, which we'll jump into real quick here. But it's not going to be anything near, and the recovery is going to be fairly substantial. So this is a really great kind of summary that was put together by Merrill Lynch and the B of A folks. There's three primary reasons why we think that there's going to be a tame kind of correction and then a move up. Is that the market was well positioned heading into the recession. I'll have some data on that a little bit later to show you. There was just not much inventory at all and an incredible amount of demand, not only overall, but especially from the millennial generation who are in their prime first-time home buyer years and their prime move-up buying years. You know, lending standards have been tight with high credit scores, reasonable down payments. We talked about that on the previous page. We're not going to be seeing forced selling of foreclosures because home prices should be much more stable. And lastly is that government policies, most notably the forbearance programs, are going to keep people in their homes and avoid forced sales. So you can kind of look at what their expectations are. There's going to be a pretty substantial drop in home sales. This has nothing to do with price. Home sales in the second quarter, in third quarter, but then you see it start to ramp up. When we get into the third and fourth quarter of 2021, this is when you see a really pretty massive uptick there. And you can see home price indexes, still coming up here in a little bit. And this was, mainly due to the remaining inventory that was there. And then it starts to drop a little bit and kind of move back up. So we'll dive into this here. This is kind of the expectation from B of A and Standard & Poor's, the rating company. But you can see it's a pretty sharp downturn in recovery, right? And so the reason is we're going to have, there'll be some regional divergencies here, but there's going to be entry-level homes that come on the market because people necessarily can't afford them. But there's going to be an incredible amount of entry-level demand that's going to prop that back up, right? Especially with where low interest rates are headed. So they're looking at, through April 21, maybe a 2.3% year-over-year drop from April of this year, but a quick recovery because of a healthier economic backdrop. This is one that's really interesting. So again, we talked about the 4 to 5% average real estate appreciation over time, right? Everyone kind of had this same analysis moving forward. This was pre-COVID. This was everyone's estimation. We're probably going to move forward over the next 4 to 5 years at a steady 3 to 5% growth rate, depending upon the market. Now, obviously that's been updated, right? So we're now expecting a move down, so we'll see, as opposed to 4% growth, we'll see about a 1.5 to 2%, maybe up to 3% correction really quick, right? And just this kind of 6-month span. And then the latter 6th month we're moving up, but then a really sharp move up to 7%. And then over time, leveling back down to your kind of standard 3 to 5% growth over time. And so when you look at this, talking to people about, getting in, and I promise you timing, it never works, right? Like, depending upon what you're buying for, if your clients are looking at buying for a primary residence where they're going to, have their livelihood, right? Where they're going to raise their family, where they're going to live, where they're going to be every day. What I can tell you, not only from experience, but from, helping thousands of clients buy homes, is that nobody's going to be sitting in their home 10 years from now or 15 years from now thinking, man, I wish I would have saved, 3 to 4% on my home, right? Or I wish I would have bought at the absolute low here and moved up and maybe got a 5% adjustment. People just don't think that way, right? But the challenge is, if a home buyer waits for this and they wait a little bit too long, this is when you're going to see multiple offers, right? You're going to see cash offers coming in. You're going to see all the money that got liquid over the last 60 days from institutional investors. They're going to come steamroll the housing market, and they're going to be buying homes because everyone's going to have the same strategy. So you wouldn't even get in that home. You'd have people bid it up to a point, which is what creates this move up. It's going to be simple supply and demand that moves us up to that 7% number. And it's going to be people are outbidding each other for homes, continuing to raise prices up. So having the opportunity to get into a property as a home buyer, a property that you really love and enjoy, because we're right around here, right? And you can have really phenomenal interest rates and no competition, and potentially even getting, if you want to make up that 1 or 2%, you could even potentially ask the seller for that 1 to 2% in terms of seller concessions. They could buy your rate down. They could pay for your closing costs. You can make up this small dip just by having seller softening, right? Seller could be a little bit more open to working with you, but as soon as you get to here, that's off the table. right? Sellers are not going to be willing to work with you. They're going to have multiple offers. So the opportunity for you to get your home that you want to be in for 10 to 15 years is substantial now into the next 6 to 12 months. That is going to change drastically after that, based upon what we see. And it's not just this graph. When you look at these things over time, this is another very similar graph, right? It's from completely different sources. Federal Housing Finance Authority, MBA, and Moody's Analytics. Right. The previous one was B of A Global Research. Right. And so this is also showing, housing affordability and short supply, or affordability being good, short supply, housing price declines will be limited, and given tight mortgage underwriting and plain vanilla fixed rate mortgage loans, and so too will the foreclosures. So you can see that the green line is the foreclosures increasing, right? So here we are with foreclosures now, and then you'll kind of see that spike up a little bit, but then it'll level off, nowhere near where it was in the Great Recession. But then you see, here we are now, and you see that small little dip. Right? And then you see that same recovery. So I've looked at probably 30 of these charts and have not seen one that differentiated from this yet, which just leads me to believe that, again, assuming the first slide we looked at in regards to the virus proves to be accurate, the rest of these should follow, right? There's a lot of that's what that based off of. Now, if that virus thing gets squirrely and moves around and that graph is becomes non-helpful, then we're going to constantly change these numbers. Next is going to be mortgage rates, right? So we have a 30-year mortgage rate going back to 1973. So, rates were around 7%, and this is really the driver here. So if you're paying attention to any of this, pay attention to this part. I know it's long and it's not the most titillating topic in the world, but 8%, 10%, we saw, rapid inflation. We saw rates spike up in the early 80s to 18, 19%. I'm sure we've all heard the stories of that time, and then we saw rates kind of move down. So there's been a continual trend down since 1982 from a mortgage rate perspective. One thing that's interesting is, again, when you think about what a lot of people think is the golden era of real estate housing was 2000 to 2006, right? I mean, interest rates were 6 to 8%, 8 dropping to 6, right, from 2000 to 2006, right? So homes are way more affordable now, and actually, we have higher earnings, right? We have higher average income, so the affordability index is higher today, but we're at 3.31% kind of average on a 30-year fix, which is phenomenal, right? It's the only other time we saw that was 2012, 2013, a little dip in here. So there's been dips down there, but the interesting thing is that we're not even done, right? So why are rates not lower, right? Because the 10-year Treasury is typically what 30-year interest rates will correlate to. 10-year Treasury is at 0.6 right now, which is incredibly low. It's no one ever thought we'd see that. With that, with the 10-year Treasury being at 0.6, the correlation for mortgage interest rates should be in the 2% range. So if you hear people saying, why are rates higher than they should be, and you want to smack them because you think 3.31 is not a high interest rate, there is some truth to that. One of the things is capacity, right? So mortgage lenders typically, as an industry, will do about $2 to $2.5 trillion in mortgage loans per year nationally. There is about $12.5 to $13 trillion worth of loans outstanding in America. When we get to a point when rates get to the low 3% range, or even into the high 2% range, or the mid 2% range for 15-year mortgages, almost 90 to 95% of that $12.5 to $13 trillion is what we call in the money, right? So almost all of that money should or could potentially or would want to refinance, access equity, access cheap money, and then even more people will want to buy real estate on top of that. So we have to handle what would be 7 to 8 years. We have to, not just the existing debt, but the new debt that would be created from people buying homes. We'd be looking at 6.5 to 7 years worth of doing mortgages in 1 year or in a matter of months. So we have this backlog of people trying to get mortgages, and mortgage companies just don't have the capacity. We weren't staffed. Nobody saw this coming. So it's going to be a challenge for people to get those interest rates, which is why there's a little bit of a cushion there. It's not the main reason, but it's one of them. Liquidity is another challenge, is that all mortgage lenders, for the most part, operate off of warehouse lines. Even the bigger banks oftentimes don't always own the loans. They'll sell them, and on their warehouse, they'll fund them with their own money, and then they'll sell them off on the secondary market. Now, if you don't have all the money in the world on your warehouse lines, you can't lend all the money in the world on your warehouse lines, right? So you're going to be constrained by your liquidity and your capacity. So you want to keep this buffer, which is why if any of you want to do an interesting study, normally if you went to bankrate.com and you typed in any mortgage situation, it would show you all of the quote unquote low price leaders, right? The online, rate table people where they quote some ungodly low interest rate and who knows if it's right. Well, now there's none of that happening. You can go there and it just says, because of all the challenges, lenders aren't lending essentially. And it'll show you kind of an average 30-year fixed rate, which would be similar to this, which just goes to show you they're full, right? They can't take on more business. So they're not even quoting interest rates at the moment. We've had people from some of the larger banks call us, some clients say, look, I can't even get anyone from our bank to call us back, right? We're not, they're telling us they're not doing refinances right now. A lot of people aren't doing cash out. They're not allowing people to access their home equity. So there's challenges in the mortgage industry that are keeping rates kind of artificially inflated. But the most important one is risk. With everyone going into forbearance, or not everyone, I think there's 7.5% to 8% of the people in forbearance now expected to move to 15%, maybe even 20%. Lenders aren't super excited about the potential losses they're going to face when their clients go into forbearance, because there's no bailout from the GSEs or the government, the Fannie Mae and Freddie Mac, backed entities. So if I'm a mortgage company and the more mortgages I do, the more risk I have and the more money I could lose, then I'm not really interested in bringing on a ton of more business, because I'm going to potentially lose it on the other side, right? I'll lose any income I made and more. I could actually be digging myself into a bigger hole if I'm not careful. So what I'm going to do is I'm going to artificially inflate the interest rate a little bit to kind of hold off any risks. So this will subside. We hopefully expect it to happen in the next 30 to 60 to 90 days. What we're telling everybody, and what we'd advise you all to tell people as well, is try and, if you can hold off on refinancing today. I think, unfortunately, there's a lot of lenders out there that are selling mortgages, right? They need to make money right now. So they're going to tell Mr. Smith to lock his loan and pay points or take a higher rate than will show up later. We're advising all of our clients and all of our partners' clients to get in position. We're doing an interest rate reservation system where people can, basically tell us what rate they want to target. And then as soon as we see that rate show up in the best capacity, right, when all these things subside, we'll have them underwritten. We'll have any appraisal situation taken care of. We can immediately take advantage of an interest rate and move forward without them paying substantial points or stripping equity from their home to go get that low rate. So I can't tell you how many clients I've seen that have sent over loan estimates from other companies that show 2 or 3 points in discount costs to get an interest rate that's not even very good to begin with, right? But that's a mortgage company selling mortgages as opposed to advising a client as to what's in their best interest. So please understand that, and understand this is what's coming, right? So if you look here, this is Fannie Mae's annual housing forecast. This is from April. Their May report will be coming out most likely in the next couple of days. I would assume probably by Monday or Tuesday they'll have the May report. So if you're interested in getting that, just email us at team@ryangrantteam.com, and we can send you that updated report. And you can actually sign up for our weekly email distribution and all the information that we put out there as well. But you can see here, this on the previous month and the March forecast, these were higher numbers. These were 3.4, 3.5, 3.2. But they're forecasting 3.1, 3%, 2.9 for the last 3 quarters of 2021. Right, so 15-year mortgages are going to be in the 2.3, 2.4 range, which is just incredibly cheap money. Right, so there's a reason why we're not refinancing. I get so many phone calls and texts be like, "You must be so busy refinancing everybody." It's like, well, we're getting people in position to refinance. We're doing that legwork, right? We're creating an ability to keep them in the front of the line, because the line to refinance will wrap around the globe. I mean, it will be substantial, and it'll take people years to be able to access a low interest rate because of capacity and challenges. So we're helping clients get in that position to take advantage of the rates when they present themselves. So, I mean, just understand this. And this is also why the forbearance thing is big, because if you go into forbearance here, in the second quarter of 2020, you may not be able to get a mortgage until you get back in current for 12 months, which means you could catch the tail end of this, but there's no certainty that these are going to be accurate, right? They're they're projections based upon economic data, but I'd much rather take advantage of it around here to make sure I get the interest rate that is going to be incredibly beneficial and financially helpful for years to come. So some information here that I thought would be helpful to share. I think when people are looking at this, it's not always a bad thing to see kind of a slowdown in this short term. I did some research in Colorado Springs. The median sales price went from $315,000 in March of last year to $352,000 in March of this year. I mean, that is a over 10% jump in 1 year after pretty fairly substantial jumps moving up to that point. So a lot of markets have had very similar increases in sales prices for 8 straight years, and prices were just kind of getting out of control from an affordability perspective. Rates were helping, but it was really difficult for the average middle class person when they're having to spend about half of their income on the cost of their home, right? So we're working with buyers that in Orange County with an $830,000 average home price that are really just struggling to paying half of their income to buy a median price property, and that's not fun, right? Buying a home should be a privilege. It should be something that provides wealth long term, and it doesn't make you feel like you're chained in by that house. So there's going to be some opportunities here. Buyers hoping for price drops. Home buyers are going to be stressed out by constant 10% year-over-year price increases. So because buyers are hoping for price drops, they'll probably be waiting, right? They'll wait on the sidelines and hope prices come down. And even though they might, again, what we talked about earlier, they may miss the opportunity there. People lost their jobs. There's going to be fewer folks who are ready to buy a home. So this is that window of time for buyers to take advantage of the drop in demand now. Because when this thing right sizes, and we all have to hope it will, that the drop in demand for housing that exists today will subside, right? It will become a very substantial demand for housing, and so getting in when everyone else is getting in is never the right thing, right? There's a reason why Warren Buffett has more money than most people. It's because he always bucks the trend. He's always buying in down markets and selling in high markets. And most people don't have the guts or the wherewithal to do that. We have so many clients that bought homes in 2000, the latter part of 2009 and beginning part of 2010. And I remember personally just thinking, what are you doing? Like, we're in a crazy market right now. Like, why are you buying a house? And they were the smartest people in the world, right? Their homes are worth an incredible amount more today than they were back then. And then lastly, it would just be increased supply and short-term decrease in demand. We're going to see sellers that are willing to negotiate. So that's kind of what I talked about, is that if you're waiting for that 2 to 3% drop, you may be able to recover that with your offer, right? You may be able to write an offer, and if the seller is willing to negotiate with you because they have a need to sell that house, or a demand to sell that house, you could make up waiting for the next year to get a 2 to 3% drop. And then you could be already in the home when the upside hits, right? So it's important when you're working with a mortgage professional or a real estate professional to understand how to be structuring offers in today's environment, ways in which you could take advantage of a kind of a pre-thought out price drop or a potential market shift. So just make sure you're talking to anybody about that. And for all the professionals on the call today, make sure you're utilizing that strategy with any prospective buyers. So then in terms of how are we best helping our clients, lastly is we want to fully analyze the current and near-term financial situation. We can't just say do this or do that or the other, because it's different for every person, right? So if you're not comfortable with it, make sure your mortgage lender has the capability of doing a holistic, in-depth analysis of someone's financial situation, not just credit, income, and assets, but insurance and protection. We call it long-term generational wealth opportunities. How is their parents going to impact them, their children, intergenerational living situations. We want to look at every aspect of someone's situation and really help them analyze that. So as a mortgage or real estate professional, or obviously as a financial professional, they would do that. Next would be to develop a strategy for navigating any losses or bad decisions, right? So there's going to be people that may not be in an opportunistic position, right? They may be on the other side of that. They may be in a position where their opportunity is just to not get hurt too badly during this, right? So should they be going into forbearance or should they not? Should they, be selling their house right now or should they not? Should they be selling stock or accessing money from their 401k or their IRA because of the CARES Act, which allows them to access it penalty-free? Right? We really need to help them navigate, okay, how are we going to get through this, right? Because their life will change, it will evolve, and we need to make sure that we're helping them take those steps as real estate, mortgage, and finance professionals. Next is going to be get secondary guidance from industry experts. So even though we're well versed in tax planning and financial strategies and real estate and some legal estate planning matters, we don't ever step into that arena, right? We know the questions to ask, we know what to look for, but then we immediately put them in touch with the right professional, or we will work closely with their current professionals to develop whatever strategy we think is right? Because we don't want to say do this and then have a differing opinion from somebody who really owns that space. So now more important than ever that you are surrounding yourself with these groups of people, right? You kind of want to be that family office for the average homeowner or the average prospective homeowner to really get insights from all different industries. So you're all kind of on the same page. And then lastly would just be continual support and guidance on a monthly basis. As you know, I think there's one more here in providing relevant, timely content. I think both these go hand in hand. What I'm telling you today could be vastly different 30 days from now, right? So we'll do these every month as we get more information and more data comes out about what's happening. The challenge is if I just tell you this now and I don't follow up with you a month later, if you're my client, and I don't give you relevant content, relevant information as it comes out, I could be telling you something that has drastically changed, but you may still be going down that path when that path has shifted, right? So that's why it's so important for us to stay engaged as to what's happening with the marketplace in every aspect, in every sector, so we can help our clients navigate appropriately to the right place, right? Opportunities, avoiding bad decisions, avoiding negative circumstances. So just continue to do that. And again, lastly, before we get into that contact information, I thought this was great. It said, America was not built on fear. America was built on courage and imagination and unbeatable determination to do the job at hand. We're all looking forward to this thing ending. That day is coming, and we know that there's a light at the end, and I think we're all starting to see it now, and I think it kind of feels good. We feel like the distancing has worked. We feel like the measures we've taken thus far, although drastic and having lasting impact on our society and our economy, may have been necessary to really accomplish what we need to long term. So stay in it, not only personally and professionally, but for your clients. They need us to be on the front lines of knowledge and data to help them navigate these times. So if you have questions or any follow-up questions, or you want to talk through anything, our website is here. And again, we'll send this out to everybody. This is our Art of Homeownership website. If you're interested as a consumer in getting all of our services, it doesn't cost you anything. There's no commitment. We're not selling you anything. You just get 6 very distinct, very valuable services during this time that help you navigate these times. You can go there and sign up. If you're a real estate partner or finance partner, you're interested, you can go to that site as well and learn more about it. We really believe that we want to proactively help prospective homeowners and current homeowners in every area of real estate or finance, and we can be extremely valuable there, and we do that through that platform. You can email team@ryangrantteam.com if you want to be on our weekly updates and our informational sessions. We'll do webinars whenever we do something, whether it's online or hopefully in person one of these days. We'll make sure to send it out to everybody in our contact list, and then our phone number is on there as well. So, well, thank you guys again for your time. We'll look forward to chatting with you all soon. Comment on social media if you're watching it there. Feel free to share this with other people. I think spreading this information is incredibly, not only selfless, but necessary. And I think it will help a lot of people kind of navigate. So everybody have a great weekend, and hopefully we'll be out and about here and back to work soon. Thanks, everyone.